How do you choose what companies you want to invest in? Hey guys, welcome back. I recently had that question posed to me by a subscriber, and I thought, what a great idea for a video. So, I will start out by saying that unless your investing style and what it is you want to get out of your investments is exactly like mine, there's a good chance that we may not agree on the things that I say in this video. But I think to understand what companies you want to invest in, you first need to identify what it is that you want to get out of your investments. So for this video, I'm going to go over what my and my wife's philosophies are and exactly what we want to get out of it. But I'll also touch on other possibilities and things that might be attractive to you. Stick around. I thought the best way to start this would be to talk about some of the different companies out there and identifying kind of a segment that we could put those in. And I'll start with blue chip stocks. Blue chip basically means these companies have been around for a long time, they're well established, typically don't have a lot of debt, or they don't need to finance a lot of debt for growth. They've already gone through that. They may or may not have dividends, but you know you're going to get a steady increase over time, but you're not going to get those 20 and 30% swings. They're well established. And in Canada, two examples of blue chip stocks and two stocks that we have in our TFSAs are Fortis and Canadian National Railway. So there's a little bit more about the two of those as to why we're invested in them. And I'll touch on that near the end of the video. The next segment I would call the growth stocks. These are typically companies that are relatively young and not been around for long. They typically do not pay out dividends because the majority of the earnings that these companies make go back into growing the company. A good example of a Canadian stock that is a growth stock or has historically been a growth stock would be Shopify. Shopify was in the $1,900 to $2,000 range pre-COVID. They've since run into a big drop in price along with a stock split. But Shopify was a great example of a growth stock that just skyrocketed and skyrocketed pretty quickly. The next type of stock that I'll talk about is an income stock. These are typically companies that, again, have modest growth, but investors look at them for more of a monthly or quarterly or even an annual income from the company. And these are companies like utilities, again, which Fortis is one. Another one that we have in our portfolio is Northland Power. So again, generating income, being paid out in dividends to the shareholders, but not a huge expectation of growth in the stock price. The next one we will call cyclical. These are cyclical industries that depending on the business cycle that we're in, may be really doing well in a bull market or potentially struggling in a bear market. And some examples of these stocks would be airlines, machinery, and even railroads. An example in our portfolio is Exchange Income Corporation. And again, I'll come back and talk about that near the end of the video because there's a little bit of specific to Exchange Income Corporation. And the last one that I'll talk about are known as interest rate sensitive companies. So as interest rates rise or drop, it totally affects certain sectors of stocks. For the most part, banks are very, very positive in their earnings when interest rates go up. At the same time, when those interest rates go up, other companies that carry a lot of debt are strapped with now more expenses than normal, and that affects, of course, their bottom line. So companies with a lot of debt, like real estate investment trusts and certain renewables or utilities even, who do carry typically a lot of debt, they'll suffer, and that doesn't hurt their bottom line, which then in turn shows and reflects in their share price. Okay, so how do I pick a stock? Well, I've said in a few videos in the past that my wife and I are more income seeking than growth right now And to be totally honest with you, really don't have anything that is a growth stock with zero dividends. Not entirely true. I do have a couple of real long shots, and I'll maybe touch upon those in a future video. But these are stocks that I just threw a few dollars at. And when I say a few, I'm talking 40, 50, $100. Penny stocks, pretty much, that I thought, you know what, I love the concept. It's a great idea. Let's see if something happens with it. But the majority of our investments are in income paying stocks. And I said earlier that I would come back and touch on a couple of the companies that I mentioned, like CN Rail, Fortis, and Exchange Income Corporation. Because of what's happened in the last 2 years with COVID and the drastic drop in prices for a lot of these companies, they've really become a great opportunity to become a growth stock. Now, I'm not suggesting for a second that we will get back to pre COVID stock market prices and numbers, but at the same time, I can't say that we're not. So, if the fundamentals of a company haven't really changed and we're now out of the pandemic, what is to stop the companies from getting back to where they were? And for the most part, if you look at a number of different companies across the TSX, you could say that about many. So I apologize if this video wasn't about looking at free cash flow and balance sheets and annual reports, but this is really a great time to invest in companies that you know, for the most part, are blue chip companies in a lot of cases, or at least well established companies. If I was in my 20s, I'd probably be into some growth stocks and taking that chance, but I'm not in my 20s. So I'm investing in companies that are solid, that have great income dividends being paid out to me, whether they be monthly or quarterly. But at the same time, a lot of these stocks that I'm into right now, they have really dropped from previous highs and pre-COVID prices. So in a way, I want it all. I want the dividend income and I want the capital appreciation. And when I look at stocks such as Exchange Income Corporation and Canadian National Railway and Fortis and TELUS and things like that, there's no doubt in my mind that over time, these stocks are going to give me a fairly decent to good capital appreciation. At the same time, they're going to pay me monthly and quarterly dividends. So hopefully that explains how I've chosen my stocks. I'd be interested to hear from you down below how you choose yours. What is your philosophy? Are you looking for income? Are you looking for growth? Or is it a combination of both? I want to thank you for hanging out and taking the time to watch this video. As always, if you've enjoyed this, I would ask you to please consider subscribing by hitting that subscribe button. Take care, and we'll talk to you soon.